up some volumes as well. We'll track this one. Harsha Upadhyaya is with us, President and Chief Investment Officer, Equity at Kotak Mahindra Asset Management Company. Harsha, great to have you with us here. Thank you very much for your time. Banks are starting to move finally, Harsha. That in a way, expectation which has been espoused by so many that it's the safest part because valuations are not, out of whack, and this should do well. And everything which is happening in the economy feeds into banks and financials at the end of the day, and one is starting to see participation. Your thoughts?
Good morning, Prashant. Yes, clearly we have been talking about banking and financials for quite some time now. If at all there is a pocket of comfort in terms of valuations in the market, definitely it's one of those pockets. And we have seen consistent credit growth. There are no issues on the asset quality side as we are at the nascent stage of our new upcycle. So overall, I think this sector also doesn't have so much of over ownership that it used to have in the past. So all in all, I think it's a valuation comfort that you'll get if you are investing into this sector. And anyways, there is a reasonable amount of growth that you can look forward to from a medium-term perspective. So definitely one of the sectors where you need to have good exposure.
Okay. By the way, there is a lot happening in the market, so don't be fooled by the flat move on the headline index. Just look at the moves. Axis Bank, by the way, is at a fresh 52-week high, above the 1,000 rupee mark, 1,060. Talking about 52-week highs, Hero Moto is at a fresh high, and a lot of people have been talking about the underperformance that Hero Moto has seen compared to its peers and how it could play catch-up now. So it's a fresh 52-week high over there. Hindustan Aeronautics, fresh 52-week high. Muthoot Finance, HCL Tech, across the board really. Ultratech Cement, Lupin, Titan, Colgate, the list is endless. Harsha, thanks a lot for joining in. I wanted to talk about a couple of spaces, right? One of them is banks, because now we are seeing participation come back. The bank nifty has broken out. There's large delivery-based buying in a lot of private sector banks. As a retail investor, has the time come to allocate more money to private banks now?
Sonia, clearly banking is one of the fulcrums of our economy, and as economy continues to move along 6.5–7% kind of GDP growth, definitely there is going to be a reasonable strength in terms of credit growth that we can expect. And also, as we have all seen, the asset quality cycle has improved quite a bit. There are no big issues that you need to be worried about. And also, this is a sector where, if you look at the recent performance, it has lagged the overall market performance or the performance of some of the sectors which have clearly outperformed this sector. So from that perspective, I think not only you are looking at a reasonable amount of growth as you go forward, you are also having comfort of valuations and not so much of over ownership in the sector. So I think whether it's an institutional investor or a retail investor, I think it's one of the good spaces that you can really look at.
Harsha, what are you doing across portfolio? I mean, what's the view? It's been a good run for the markets across the board. But are you with the margin still holding that overall slightly cautious view, Harsha?
Yes, on the broader end of the market, we are slightly cautious. As we have spoken many times earlier as well, the valuations are slightly beyond our comfort levels. However, on the large cap side, it's very well within our zone of comfort. So we continue to like large caps over mid and small caps in that sense. Overall, on equities, we are still constructive. The last quarter earnings were very, very good. There was about a 7% beat on earnings. As we go ahead, we may not have the kind of favorable base that we had in June and September, but still the growth is going to be reasonably strong, high teens kind of growth. So overall, we are looking at reasonable returns from equities, even from the current valuations. However, on the mid and small cap side, one needs to be a little cautious given the valuations which are higher than our comfort and higher than long-term averages as well. And also the earnings expectations are much higher in the mid and small caps as compared to large caps. So in case there is any headwind, the volatility could be higher both in terms of earnings as well as in terms of market performance in mid and small caps.
So how are you sort of protecting yourself from any downside in those two mid and small caps? What actions are you taking, Harsha? And where are you sort of trimming, selling? What exactly has been the strategy?
We have been very cautious on the valuation. So in the pockets where we feel uncomfortable on valuations, we gradually continue to reduce our positions within mid and small caps. We also keep a very, very diversified portfolio in these two segments. So to that extent, we kind of manage our overall risk from a portfolio construction perspective, which is very, very diversified. And also we have a little bit of cash. It's not that we are managing volatility through cash, but definitely cash gives you an opportunity whenever there is volatility in the market. You'll be able to buy some of the stocks that you like at probably slightly lower valuations. So that also gives a little bit of comfort. And also if you see any unforeseen redemptions, which have not been the case until now in this segment, but in case something happens, we should also be able to give the money back to the investors without really impacting the portfolio. So that's the thought on mid and small caps.
Harsha, how are you all placed on the pharma space? You know, if I take a look at the pharma space, that's outdone the Nifty for this year. And remember, it went through a few years of absolutely doing nothing. So select stocks are doing quite well out there. What's your view? Do you stick to some of these domestic names, or would you like some of the US generic names?
We have a mix of domestic as well as export-oriented pharma names in our portfolio. In fact, over the last couple of months, we have slightly increased our overall exposure to pharma. And as we speak, we have also launched an healthcare fund, which will be focusing on the theme of hospitals, pharma, and other related sectors. So we believe that from a medium-term perspective, there is a reasonable amount of traction that we are seeing in terms of the growth rates, and probably a good time to really build that thematic exposure here.
Okay. I wanted also your thoughts on the IT space. How are you feeling about that now? Do you think there could be a degree of outperformance on IT purely because what's happening with, you know, lower bond yields in the US, as well as now lower risks of a recession? GDP growth has picked up over there. Would you put more money to work here?
Not yet. We have been watching what's happening to US Treasury yields, but it seems more like a short-term reaction to what has happened in terms of Fed reaction to interest rate hikes in the recent times. However, given the strong rate of growth in the US economy, very unlikely that US will be looking at cutting interest rates anytime soon. So I don't think you are going to get that kicker in terms of valuations because of lower interest rates. And when you look at overall business momentum, it is still very patchy. So to that extent, there are many other domestic sectors which are offering better growth at this point of time. So while we continue to hold some names in the IT sector, but it's not being one of the overweight positions in our portfolio.
Okay, all right. We leave it at that. Harsha, thanks a lot for joining in, and have a great day. Well, for the market, it's very, very quiet, but IRDA is really the star of the show. 13% higher now on that stock. A big bang listing, and I think over 1 crore shares trading.